$38 trillion. That is America's national debt right now. Not a projection, not a future estimate. The actual number sitting on the books as of December 2025. And if you think that number doesn't affect you personally, I need you to listen very carefully, because while most people were scrolling social media and binge-watching Netflix, the largest financial institutions on Earth began doing something they have not done in 75 years. They are quietly moving massive amounts of capital out of dollar-denominated assets. No headlines, no emergency speeches, no breaking news banners, just filings, Treasury data, capital flow reports, numbers anyone can verify. By the end of this series, you'll understand exactly what's happening, why it's happening, and most importantly, what comes next. Because this isn't random. It's not political. It's not opinion. It's a pattern. A mathematical pattern that has played out 3 times over the last 500 years. Same stages. Same warning signs. Same timeline. Same devastating outcome. And we are watching it unfold again right now in real time. Global debt has just crossed $251 trillion. According to the IMF, that's 235% of global GDP, the highest ratio ever recorded in peacetime history. U.S. debt alone jumped from $36.1 trillion in January 25 to $38.40 trillion by December. 2.3 trillion Australian dollars increase in just 11 months. But here's what almost no one is talking about. Every time this exact setup appeared in history, the country holding the world's reserve currency collapsed within 36 months of the smart money leaving. Not similar collapses. Identical ones. The pattern is mechanical, predictable, and once it reaches a certain stage, unstoppable. Let me show you how it works. Every major financial collapse of the last 5 centuries followed the same 4-stage cycle. Stage 1, Ascension. A nation becomes the center of global finance. Capital floods in. Its currency becomes the standard for international trade. Banks expand. Markets boom. Innovation accelerates. Confidence is absolute. This phase typically lasts 50 to 80 years. Stage 2, Overextension. Success breeds arrogance. Governments spend beyond their means. Wars, foreign interventions, social programs funded by debt. Asset prices soar. Stocks hit records. Real estate explodes. Central banks print to keep the party going. Debt grows faster than the economy. This phase lasts 20 to 40 years. Stage 3, the silent exodus. This is the critical phase. The public doesn't see it. Politicians deny it. But the people who read balance sheets, the insiders, know. Capital begins moving quietly out of the system. Institutions rotate away. Foreign holders reduce exposure. Wealth disperses internationally. No panic, just precision. This phase lasts 18 to 36 months. Stage 4, Collapse. The reserve currency breaks. Foreign holders dump assets. Inflation explodes. Interest rates spike. Stocks, bonds, and real estate crash together. Banks fail. Pensions evaporate. The middle class is wiped out. And everyone asks the same question. How did we not see this coming? The answer is always the same. The pattern was there the entire time. To understand what's happening now, you have to see how this pattern played out the first time with the most powerful empire on earth. Spain. 1500s. No debate. No rival. Spain was the global superpower. Spanish galleons crossed the Atlantic, loaded with more gold and silver than the world had ever seen. Entire mountains of precious metal poured into Europe. The Spanish real became the world's reserve currency. If you wanted to trade internationally, you needed Spanish money. Madrid was the financial center of the known world. Stage 1 complete. Spain controlled half of Europe. Its armies were feared. Its navy dominated the seas. The empire stretched across 3 continents. Wealth flooded in nonstop, and for a time, it looked limitless. Then came stage two. Spain spent like an empire that believed it could never fall. Endless wars with France, England, the Dutch, the Ottoman Empire, a bloated bureaucracy, lavish royal courts, monumental palaces, a military machine stretched across the globe. By 1550, Spain was spending 300% of its tax revenue, 3 times what it collected. The gap was filled with debt borrowed from Italian banks, German financiers, anyone willing to lend. But no one panicked. Why would they? Gold kept arriving from the New World. Asset prices rose. The economy looked strong on the surface. Confidence remained absolute. That's how stage two always works. Then something changed, and almost no one noticed. Stage three, the silent exodus. In 1555, Spain's largest creditors, the Fugger banking family, began demanding repayment in gold, not promises. That alone tells you everything. They didn't want paper. They wanted out. A year later, wealthy Spanish merchants began shifting operations to Genoa and Amsterdam. Not loudly. Not all at once. They opened secondary offices, redirected trade routes, moved inventories quietly. Why? Because the balance sheets were screaming the truth. Spain was paying up to 40% interest on some loans. 40% is not a sign of strength. It's a flashing red warning of systemic failure. The insiders knew Spain was functionally bankrupt, even while the public believed the empire was eternal. Then came stage four, 1557. Spain defaulted on its debt. Credit markets froze overnight. Spanish bonds became worthless. The government seized private gold shipments to pay soldiers. The king promised it was temporary. It wasn't. Spain defaulted again in 1560, again in 1575, again in 1596. 4 defaults in 40 years. Inflation destroyed savings. The middle class collapsed. Military power evaporated. The empire never recovered. By 1600, Spain was a shadow of itself, irreversibly broken. The golden age was over. And here's the most important part. The money didn't disappear. It moved north into the Dutch Republic. Amsterdam rose precisely as Spain fell. Capital doesn't die. It migrates. Which brings us to the second empire in this cycle, the Dutch Republic, and the most advanced financial system the world had ever seen. By the early 1600s, the center of global finance had shifted north. From collapsing Spain to a rising powerhouse no one saw coming. Amsterdam. At its peak, Amsterdam wasn't just rich. It was the richest city in human history up to that point. The Dutch Republic had done what no empire before it had achieved. It turned finance itself into the engine of global dominance. The Dutch East India Company became the most valuable corporation ever created, worth an estimated $8 trillion in today's money. More than Apple, Microsoft, Amazon, and Google combined. Twice. The Amsterdam Stock Exchange was the first of its kind. Modern banking, global trade finance, futures contracts, much of what we consider advanced finance was born here. The guilder became the world's reserve currency. International trade ran through Dutch banks. Capital from Asia, Africa, the Americas, and Europe flowed into Amsterdam seeking safety and returns. Stage 1: absolute dominance. For a moment in history, the Dutch Republic was Silicon Valley, Wall Street, and London rolled into a single city. Then came stage 2: war. Always war. Between 1652 and 1674, the Dutch fought 3 brutal wars with England. They battled France. They clashed with Spain. Maintaining a global empire from Indonesia to South Africa to Brazil required enormous military spending. Government debt exploded from 4 million guilders in 1650 to 80 million by 1690, a 20-fold increase in just 40 years. To fund it, The Dutch did what every overextended empire does. They printed. At the same time, speculation went insane. Tulip mania wasn't just a bubble, it was a psychological warning. Tulip bulbs sold for more than houses. A single rare bulb could cost 10 years of an artisan's wages. Prices detached completely from reality. Everyone felt rich. On paper. Behind the scenes, something far more dangerous was happening. The Bank of Amsterdam, considered the safest institution in Europe, was secretly lending depositor funds to finance government spending. It claimed to hold full reserves, but it didn't. It was running a fractional system decades before the term existed. In plain terms, a legally protected Ponzi scheme. Stage 2 fully locked in. Then, quietly, Stage 3 began. By the 1690s, elite banking families started relocating to London. Sephardic Jewish merchants, the backbone of Amsterdam's trade-shifted operations. Portuguese and German financiers followed. No panic, no headlines. Just deliberate capital flight. Why? Because insiders knew the truth. The Bank of Amsterdam had been insolvent since 1672. New deposits were being used to pay old withdrawals. The illusion worked until it didn't. The public had no idea. Then came Stage 4. 1795. French revolutionary armies invaded. The Dutch Republic collapsed almost overnight. The guilder lost credibility. The Bank of Amsterdam's fraud was exposed. Depositors were wiped out. Riots filled the streets. Trust vanished. 150 years of financial dominance, gone in months. And once again, the money didn't disappear. It moved across the Channel to London, which brings us to the third empire, the most familiar one, the British Empire, the longest-lasting reserve currency in modern history, and the most important comparison to what's happening today. By the 1700s, global power had consolidated in one place, Britain. At its peak, the British Empire controlled 23% of the world's population and nearly a quarter of Earth's landmass. The phrase, "the sun never sets on the British flag," wasn't poetry. It was logistics. For over 200 years, the pound sterling was the world's reserve currency, longer than any modern currency in history. The City of London became the nerve center of global finance. Railroads in America, mines in Africa, plantations in Asia. If it required capital, it was financed in London. More than 60% of global trade settled in pounds. The gold standard revolved around sterling. British power appeared permanent. Stage 1, absolute supremacy. Then came the 20th century. And with it, war. World War I shattered Britain's finances. The war cost roughly £44 billion, over $600 billion in today's money. To pay for it, Britain borrowed heavily from its citizens, from its allies, and increasingly from the United States. Government debt surged from 30% of GDP to over 130%. Remember that number, because it's the same level the United States sits at today. Britain tried to maintain the gold standard. It failed in 1931. It briefly returned. It failed again. The system was cracking. Then World War II finished the job. More borrowing, more printing, more promises that couldn't be kept. Britain technically won the war, but financially, it was ruined. The empire survived on American loans. Independence movements accelerated. The math had turned against them. Stage 2 complete. Then came the quiet part. Stage 3, the Exodus. By 1949, British corporations began shifting capital abroad. Unilever, Shell, British Petroleum. They didn't abandon Britain, but they stopped reinvesting there. Growth moved elsewhere. Wealthy families transferred assets to Switzerland, Canada, and the United States. Taxes were rising. Regulation was tightening. Opportunity was shrinking. Talent followed money. Scientists, engineers, entrepreneurs, academics. Britain offered decline. America offered growth. By 1960, Foreign investment in Britain had fallen 62% from pre-war levels. Capital was leaving. Talent was leaving. The future was leaving. Stage 3 verified. Then came Stage 4, 1967. The pound was devalued 14.3% overnight. One morning, the currency simply wasn't worth what it had been the day before. The government had run out of foreign reserves defending it. The game was over. 1976. Britain went to the International Monetary Fund for a bailout. A bailout. The empire that once ruled global finance had to beg for emergency loans like a developing nation. The pound lost reserve status. Global trade shifted to the US dollar. Britain's financial dominance ended permanently. 3 empires. 3 reserve currencies. 3 identical collapses. Spain, the Dutch Republic, Britain. Same 4 stages, same timeline, same outcome. Which brings us to the uncomfortable question: where is America in this cycle? Now we bring the pattern home. Because everything you just seen didn't end with Britain. It passed to the United States. 1944. Bretton Woods. America emerges from World War II as the last industrial power standing. Europe and Asia are in ruins. Gold flows into U.S. vaults. The dollar is pegged to gold at $35 an ounce. Every other major currency is pegged to the dollar. The global financial system is rebuilt around America. Capital floods in. U.S. markets become the deepest, most liquid on earth. Treasuries are considered risk-free. The dollar becomes the unquestioned reserve currency. From 1945 to 1971, America experiences its golden age. Stage 1 complete. Then came the turning point. August 15, 1971. Richard Nixon closes the gold window. The dollar becomes pure fiat, no backing, no anchor, just trust in the U.S. government. And when you remove limits, spending explodes. In 1980, U.S. national debt was $900 billion. 1,990. $3 trillion. 2000. $5.6 trillion. 2008. $10 trillion. 2020. $27 trillion. January 2025. $36.1 trillion. December 2025. $38.4 trillion, a 4,200% increase in 45 years. And that's just federal debt. Corporate debt, $13.5 trillion. Household debt, $18 trillion. Student loans, $1.77 trillion. Credit cards, $1.1 trillion. Auto loans, $1.6 trillion. Total U.S. debt now exceeds $100 trillion, roughly 370% of GDP. For comparison, Spain defaulted near 200%. The Dutch collapsed around 250%. Britain lost reserve status at 130%. America is at 370% and climbing. Now look at the interest. The U.S. government now spends over $1 trillion per year just on interest, more than national defense, more than Medicare, more than almost every federal program combined. That's not repayment. That's survival. How is it funded? Printing. Between February 2020 and April 2022, the M2 money supply expanded by 40%, the largest monetary expansion in U.S. history. The result? Asset bubbles everywhere. Stocks at record highs. Housing prices up 73% since 2019. Wages lagging. Wealth inequality exploding. The Federal Reserve's balance sheet ballooned from $800 billion in 2008 to $9 trillion in 2022. Treasuries, mortgage bonds, corporate debt, everything propped up artificially. This is textbook Stage 2 behavior. And now quietly, we've crossed into Stage 3. China held over $1 trillion in U.S. treasuries in 2013. Today, $760 billion. Japan has reduced holdings by $220 billion since 2022. Saudi Arabia is selling. Belgium reduced exposure. Switzerland is selling. France is trimming. Even the Federal Reserve is shrinking its balance sheet quantitative tightening. So who's buying used debt now? Mostly? The U.S. itself, the Fed, government funds, pension systems, circular financing printing money to buy its own debt. That's not confidence. That's desperation. And just like Spain, Amsterdam, and Britain, the smart money is moving first. Which brings us to the final stage. Now we arrive at the part everyone wants to avoid. Stage 4. Not because it's dramatic, but because it's inevitable once Stage 3 is underway. Here's how it unfolds, based not on theory, but on 500 years of repetition. The dollar doesn't collapse overnight. There's no single announcement. No press conference declaring the end. Instead, confidence erodes gradually, then suddenly. Trade begins settling in alternative currencies. Not everywhere, not at once, but enough to matter. We're already seeing it. China and Brazil trading in yuan. India and Russia settling in rupees. Bilateral agreements bypassing the dollar entirely. BRICS nations, now representing over 40% of global GDP, building payment systems that don't require US dollars. This matters because reserve currencies don't die from inflation alone. They die when demand disappears. There was a lot of noise in 2024 about the end of the petrodollar. Here's the truth. There was never a single written agreement forcing Saudi Arabia to sell oil only in dollars. It was an informal arrangement. But Saudi Arabia has now openly explored accepting other currencies for oil. The effect is the same. When global demand for dollars falls, the trillions sitting in foreign central banks don't vanish. They come home. That's when inflation stops being uncomfortable and starts being uncontrollable. At that point, the Federal Reserve faces an impossible choice. Option 1. Raise interest rates high enough to defend the currency. That instantly makes $38 trillion in debt unpayable, crashes the bond market, collapses housing, and detonates the economy. Option 2. Keep printing. Monetize the debt. Preserve the illusion of stability until the currency itself breaks. Every empire chooses option 2, and every time it ends the same way. Stocks crash. Bonds crash. Real estate crashes. Banks fail. Pensions evaporate. Insurance companies go insolvent. The middle class, whose wealth is concentrated in currency, savings, and domestic assets, takes the full hit. This isn't speculation. Spain lived it. The Dutch lived it. Britain lived it. And they all said the same thing at the end. But we were different. Spain had the strongest military on earth. The Dutch had the most advanced financial system ever created. Britain had the largest empire in history. None of it mattered. Military power doesn't defeat mathematics. Technology doesn't stop currency debasement. Innovation doesn't cancel debt. Exceptionalism is the last myth every empire believes before it falls. So what does this mean for you starting now? First, if most of your wealth is in dollar-denominated assets, you are exposed. Diversification is no longer optional. It's survival. Second, hard assets matter. Gold has preserved value for 5,000 years across every collapse. Silver, commodities, real assets that cannot be printed. Third, geographic diversification. Capital spreads risk across jurisdictions for a reason. Swiss francs, Singapore dollars. Stable systems outside a single political fate. Fourth, liquidity. Cash loses value to inflation, but in a crisis, liquidity buys opportunity. Illiquid assets trap people at the worst possible moment. Fifth, reduce debt. High leverage in a rising rate environment is fatal. Every rate increase compounds the damage. Sixth, thick skills and relationships. Human capital survives every collapse. Skills solve problems. Relationships create opportunity. These cannot be inflated away. And finally, pay attention. The people who survive these transitions aren't the richest. They're the ones who recognize the pattern early and act before the crowd. This isn't fear. This is pattern recognition. America is in stage 3. Capital is leaving. Confidence is fracturing. The math is locked in. Stage 4 doesn't ask for permission. The only question left is whether you will be positioned correctly when it arrives, or whether you will look back, like so many before you, and wonder how all the signs were visible and ignored. The information is here. The pattern is clear. The choice is yours. If you want to understand what historically protected wealth during Stage 4 and what destroyed it, subscribe. The next video breaks down the exact assets, sectors, and strategies that survived every currency collapse in history. The pattern doesn't care what you believe. It just repeats.